Okay, some major news is shaking up the Malaysian stock market. We're talking about the giant conglomerate Genting Berhad. They've just announced a plan to buy out and take its massive subsidiary Genting Malaysia completely private. Now this is a huge deal, but the reaction has been, well, fascinatingly split.
In fact, one analyst pretty much summed up the entire multi-billion-dollar offer with just 3 words: unfair but reasonable. I mean, that's a real head-scratcher, isn't it?
How can something be unfair to shareholders, but at the same time, be a reasonable offer they might just have to accept? Well, that is the central puzzle we are going to solve right now in this explainer.
All right, let's dive into it. To really get our heads around this paradox, we've got to look at the hard numbers that are driving this massive corporate move.
So, Genting Berhad is offering minority shareholders $2.35 in cash. That's for every single share of Genting Malaysia they own. That's the official price on the table.
So what does that actually mean? Well, compared to the stock's last traded price, that's a premium of almost 10%. On the surface, that sounds pretty good, right? An instant 10% gain for shareholders.
And when you add it all up, the total value of this whole buyout comes to a staggering $6.7 billion. This is an absolute heavyweight deal no matter how you look at it.
But here's the thing. These numbers, as straightforward as they seem, have created 2 completely opposite reactions in the market. It really all depends on your perspective, whether you're looking at the past or at the present. First, let's step into the shoes of the long-term investors. You know, the ones who feel this deal is fundamentally unfair. Their entire argument is all about history. For anyone who's been holding this stock for a while, that RM2.35 offer feels low, really low. Why? Because for years, the stock was trading way higher, often between 3 and even 5 ringgit. So you can see that disconnect immediately. So just imagine you bought shares when the price was high. This RM2.35 offer doesn't just feel unfair, it could mean you're actually losing money. From that perspective, it really looks like the parent company is just swooping in to buy low, taking advantage of a recent dip in the price.
Now let's flip the coin and look at the other side of the argument. This is where we get the reasonable part of the equation, and it's focused squarely on today's reality. And this right here is the heart of the paradox. Yes, the offer looks weak compared to those historical highs. But if you look at the present, the stock has been struggling, trading near its 52-week low. From that angle, getting an almost 10% premium is a pretty decent and, practical way out.
And there's another key number to think about: the net tangible asset value. Just think of it as what the company's physical assets are worth on paper, which is RM2.10 per share. The fact that the offer is actually above that book value really strengthens the argument that it's a reasonable price, at least in today's market.
So this all leads to a massive question. Why now? What is Genting Berhad's grand strategy here? Why spend billions to take full control of its subsidiary at this exact moment?
It really seems to be a classic 3-step play. First, you gain total control. Step 2, you streamline operations without having to answer to a bunch of outside shareholders. And third, this is the big one, you free up Genting Malaysia's resources to fund major growth projects, like their super ambitious bid for a new multi-billion-dollar resort in New York.
And how are they paying for all this? Well, they're not dipping deep into their own cash reserves. The vast majority of this deal is being financed with debt. They're borrowing big, betting that the future rewards of having full control will absolutely be worth it. And that borrowing has a direct impact on their balance sheet. Their total debt is going to jump, and their gearing ratio, which is just a measure of debt, is going to rise. It's a classic calculated risk. You take on more debt today for what you believe will be greater control and bigger profits tomorrow. So you have the unfair view based on the past, and you have the reasonable view based on the present. The final decision now rests in the hands of the very shareholders who are debating this exact point. So what do? Right, so the shareholders are now in this strategic waiting game. They can take the certain cash on the table right now, they can wait things out, or they can gamble a little. The hope for those who hold out is that if not enough people accept the offer, Genting might be forced to sweeten the deal with a higher price just to get it over the line. And so we are right back to our paradox, playing out in real time. It's a classic battle, the reasonable present versus the unfair past. What happens next is all going to come down to which of these 2 forces wins out in the minds of thousands of investors. It's a fascinating case study in how value isn't just about numbers, but also about timing and perspective.